Good morning, good afternoon, and good evening, everyone, and welcome to How to Navigate Angel Investment with StartOut. My name is Colin Mahan, and I'm the Director of Programs at the Nasdaq Entrepreneurial Center. And for those of you who may not know, the Nasdaq Center is a nonprofit that's building a better path for entrepreneurs worldwide by improving inclusion, access, and knowledge in entrepreneurship. As you may have just seen in the chat, the Nasdaq Center, along with our partner Mentor Cloud, launched a free mentor matching platform for entrepreneurs called Mentor Makers. You can create your own advisory board to guide and inspire you with in-the-moment mentorship from topic experts and professionals dedicated to providing exceptional mentorship to entrepreneurs across all races, industries, and geographies. So find or become a mentor today by using the link in the chat. Quick housekeeping item, we're going to open up for live Q&A at the end of the event, so please submit those questions for us at the end of the session in the Q&A function at the bottom of your screen. We'll hope to get to them all. Now, none of what we do here could be possible without all the amazing support from our sponsors, including Nasdaq, Lehigh University, Bank of the West, Airbnb, KPMG, Wilson Sonsini, Woodruff Sawyer, BPM, and HubSpot. We're grateful and humbled by their contributions. Now, during these still unique times, we're curious on how sentiment is among the entrepreneurs that we work with. So I'm going to launch this quick poll to just let us know how you're feeling about your business right now. Are you optimistic, in survival mode, feeling a little anxiety or fear? Let us know. Appreciate you voting. Looks like optimism's in the lead, but understand there are some of those other sentiments out there. Let me give this another moment or so. End that poll. Share these results. Thank you all for voting. Looks like optimism is in the lead, but there is some anxiety and survival mode out there. So hopefully our presentation today will help alleviate some of those pains. So without any further delay, please join me in giving a warm welcome to our first guest, Al Wynant, who's a co-founder and CEO of Ngomu. Al, welcome.
Hey, Colin, thank you. It's great being here with all of you today. And my name is Al Wynant. I am also, aside of being the CEO of Ngomu, I'm also the co-chair of the Denver StartOut Programming Board. And if you're not familiar with StartOut, we're an organization that accelerates the growth of the LGBTQ plus community, driving its economic empowerment and building a world where every LGBTQ plus entrepreneur has equal access to lead, succeed, and shape the workforce of the future. And if you're a founder, we also provide direct individual support through community events, one-on-one mentorship, one-on-one office hours with experts, a 6-month accelerator program, and investor connections. So check us out at startout.org.
Thank you, Al. Now we're going to invite the rest of the panel. Ben Stokes, who's the founding partner at Chasing Rainbows, and we've got Jessica Thurman, who's the co-founder of Othello. Welcome, team. Al, over to you. Looking forward to this conversation.
Thanks, Colin and Jessica and Ben. It's so great to see you here today, and I'm so looking forward to our conversation. So let's dive straight in here. So Jessica, I'm going to kick it off with you here. So at what stage should you start thinking about angel investment, and how do you decide if angel investment is the right fit for you and your company?
Yeah, it's funny because, starting out as an entrepreneur, I didn't even know what an angel investor was, actually. I knew about traditional venture capital, and I think a lot of people kind of pushed us early on thinking, oh, just go out for the venture-backed or strategic funds. And, what we realized was, those are really long-term relationships that you're getting into with somebody who's going to be, on your cap table and your board for a very long time. And so, especially at the early stages of a company, when you don't have a lot of proof of concept, when you don't have maybe all the traction and, generating revenue that a lot of the institutional funds are looking for, angel investing is a great option, especially, when you have instances where, everyone says go out friends and family round. Well, not everybody has friends and family who have hundreds of thousands of dollars that they can throw at your business. So I think for us, we realized early on that, angel investing was something that would be great for our early stages, as well as even moving towards seed rounds. I think we're seeing more and more as people progress that they can utilize angel investors, which also kind of give you a unique advantage around also having mentorship from people as well that have your back and have a vested interest in your business doing well.
That's great. And so, and follow up, Ben, maybe to you. So how can entrepreneurs, as we're talking about this friends and family round, some of us don't have access to that. So how do entrepreneurs, how do we begin raising money if we don't have access to those kind of resources?
Yeah, I think it's a real challenge trying to raise capital, right? And so getting access to capital. And so, one of the things about being a founder is that you have to really start being, being really conscious about where you start reaching out to people and how you do that as well. And so it is a methodical point that you have to start going through and start reaching out and that sort of stuff. So LinkedIn is a perfect place to find people that you may not know and may not have spoken to before. And what that really helps is that really focus on, okay, well, what is the message that I'm trying to bring out here? What is the company? And actually finding individuals who are angel investors in a particular industry as well. And so you can really start defining down who is the right target for me as a founder, and who's going to be able to help me and add interest as well. I think one of the biggest things around that is actually finding people who want to be on that journey with you, because obviously finding an investor, it's not going to be a 2 or 3 month relationship. It's going to be a 5 to 7 year relationship. And so remembering that as you build that forward is really important as well. And so finding people who you want on that journey with you, both from an investor standpoint, as well as an investor finding companies that also they want to have that relationship with as well.
So, and maybe a question for both of you here. How do you, as you're going out there for this angel round, how do you structure, what's the structure of that investment? So maybe Ben, from the investor's perspective, and then Jessica, what's the ideal for you as the entrepreneurs, from the entrepreneur's perspective?
Yeah, I think, when you're making an early investment, obviously you're raising on a safe note. And so when you're raising on a safe note, it's the promise of future equity. So that, you're really there, helping that founder get things off the ground. A perfect way to think about this is that this is their time to build the MVP or minimally viable product. And so within that, it's understanding, okay, well, what can you do in order to be able to get test the market, find product market fit, understand that, what customers are looking for. And then once you've been able to do that, you can then start looking at, raising a seed or Series A. So, and in particular, when you start thinking about angel investment, it's usually in that pre-seed or friends and family round that you're looking for these investments. And yeah, Jess, I'm sure you're able to share a bit more about that.
Yeah. So, obviously we raised under a safe. I think there are a lot of things out there. Carta is a great tool for, young entrepreneurs that they can utilize, that really gives a lot of advice and structure around what these agreements look like. I think that everyone always has the big question of, what's your valuation? And, one thing for me is that we learned with time that, everyone's going to ask that. Everyone's going to ask if you're, raising on a cap. But, a lot of times it's having a conversation with an investor of, what do you feel our valuation is? Because that's a really fluid term. And there's been a lot of huge just fluctuations in the market around valuations. And we're heading into a time now where, things look a little different from the financial community, and investments are becoming a little bit more conservative for that reason. But I think that for us, it was really finding people who were aligned with the mission. I can't emphasize that enough around, everyone always has the saying, like, money's green, right? Like you can take money from everyone. But you really don't. You get to a point where you realize when it comes time to actually start taking in funding, it adds a whole different layer of anxiety around, it's a big commitment, and you don't want to let these people down, because they are the first people who said, you know what, you have a napkin and a dream, and we're willing to take a risk on your venture. So I think that really finding the people that you feel most aligned with and your mission and values is probably the most important thing to me when it came to finding angel investors.
And stepping back on something you said a little bit earlier, I think both of you, is it at this particular stage, is it important to have a valuation, or is that sort of still the nebulous part of the whole part?
I think that one of the things is with the safe note, there is that line about, having a valuation cap where you can choose to have a valuation cap or not. So it can be uncapped as well. And so really at that point, or that's this stage of your company, like you're trying to get it off the ground. So for me, I always think, why think about any of those things first and foremost? The first thing you really need to do is actually go out and get a product out to market and actually test whether or not, your idea is actually something that people want to buy at the end of the day.
Yeah, I agree. I mean, there was so much anxiety for us early on around, what do we say our valuation is? And you'll also hear a lot of different feedback from a lot of different people. One person may say, oh yeah, I think your valuation is at 7 million right now or something. And somebody's going to have a completely different, reaction to that. So, I think that that's just a really fluid number. And I think, even around just the rounds of raising funds, a lot of those terms are very fluid. And so I think, like Ben was saying, I think really just focus in on your product, the pain points. There are ways at early stages that you can communicate and show that there's a need in the market, even before you've actually gone out and tested your product or tested what you're doing. And I think those are the areas that are useful for you to focus your attention on in the early stages.
Exactly. And to follow up on that, realistically, the valuation doesn't really get marked at all, or doesn't even get come up really until the point that a Series A investor has converted your company or to a price share. So that's really when it matters the most.
That makes perfect sense. And so Jessica, as you're out there, how do you identify which investor is a good fit for you, and what makes someone a good angel investor to work with, besides the check?
Yeah, yes, aside the money part. Yeah. I keep going back to the alignment, and I think there are a lot of investors out there that are more strictly financially focused, and most investors are making a lot of different investments, and they know that not every single one of them is going to work out. But I think that really finding people that have a drive for your industry is just so important. I mean, in the early stages, I didn't realize, I work in health tech, so it's a really specific niche. And I think that we wasted a lot of time speaking to investors who just weren't interested in that space, or, their current focus was different, or maybe they're at a stage in their fund where, or with their financing that they're trying to invest in later stage companies, because they're kind of coming to the end of their money. So a lot of it is just about fit, finding the people who at the right place and right time. And that sounds, all well and good to say in theory. But it is much more challenging. But I think that impact investing is huge, and finding people who are also interested in investing in diverse founders is really, really important.
Yeah, I definitely would agree with that. Really understanding your investor and what they invest in is really important. I often get hit up by founders who haven't really done their research and looked at my fund and realized that the fund that Chasing Rainbows only invests in LGBTQ plus pre-seed companies. Anything outside of that, we won't invest in, full stop. And so it doesn't align to our thesis. So not wasting your time, trying to pitch to people that will never invest in you is really important as well.
So Ben, aside of the deal, so to speak, when you're looking at making investments, you're obviously looking at the founder. So what makes for a good founder for you to work with?
Sure. So there's, I believe that there's, a few things that makes a founder successful. It's that grit, determination, and perseverance to make sure that tenacity as well to get that product off the ground. And so I really look at the founders that we invest in and go, okay, well, what have you done today? How far have you gone? And how far have you come with nothing? And then after that, understanding, okay, well, what would happen if we did invest in you, and where would you go from there? I look at it and think there are 4 key areas that makes a company successful. It's product, timing, team, and execution. And so if you don't have all 4 of those things, what have you done to start building on those 4 things, and where are you up to within that? I often say when I'm investing, I don't mind if the product is just fully made of scaffolding. Just, the building is just scaffolding and there are 2 mice in the corner running in a hamster wheel, keeping the lights on. If you've done that and you've been able to get customers you are worlds ahead of somebody who has a brilliant product and nobody using it. And so finding that product market fit, particularly in that MVP stage or that early stage, and proving out your product is key. So so for me, I always look at what's your MVP look like, how have you been able to get it out there, and who's using it, and what's the feedback's been so far, and to actually get that product market fit. Yeah,
that makes perfect sense. So Jessica, as you're out there, you're an experienced entrepreneur. You've been around the block, so to speak. So how do you go out there and successfully sell yourself, but also your product to investors?
Yeah, this was something that I really struggled with early on, because when you're pre-product, you are selling yourself. One of, our biggest angel investors, he doesn't have a huge background in health tech, interested in the space. But he kind of told us the analogy at one point of, he said, you can invest in the horse or you can invest in the jockey. And in this case, he said, I don't fully understand the product and around like cancer care. I mean, that's the space that we work in. It's complicated. But he said, I can invest in the team. And so it was a lot about vetting us as individuals, what is our background? What is our drive? And I think that it's really hard early on to lean into the vulnerabilities of who you are as a person. So for me, it seemed really kind of gross in the beginning to say, oh, yeah, I check these boxes of, LGBT and I'm from, the Wapton Oye Sioux tribe, indigenous background. My co-founder is first generation immigrant. All of these things, it just kind of feels gross, like you're trying to sell the adversity in your life. But on the flip side, I had been homeless at one point, and those are things that I've learned to share, when I'm meeting with potential investors, because it shows you're scrappy. It shows that you've overcome a lot of adversity in life and that you can build something from nothing. And I think that's the quality of resilience that a lot of investors are looking for.
Absolutely.
Thanks, Jessica. It's powerful. And Ben, maybe you addressed this already a little bit, but what are angel investors, looking for when making actual investment decisions, both within the product and the founder? So if you want to elaborate a little bit more on that.
I think, just echoing what Jess just spoke about then, and understanding how somebody leans into the things that they are and is their true authentic self at the same time as being able to fix a problem. And so, I really want to understand, and as an angel investor, understand what is the problem you're trying to solve and why is that problem important to you? I think the big challenge is really trying to understand, okay, well, why you, and why are you going to help fix this problem, and what is your motivation behind that? I think, at the end of the day, when you've had a rough day at the office, you have to remember that you've got to go back and keep tackling that problem tomorrow. If you're not fully convicted about the problem you're trying to solve, you won't. And so for me, I really look at that in the founders from that element of trying to problem solve. And then to add on to that around the product side of things, it's okay, well, what have you actually built? How is it being used today? What is the outcome, and who are the users? And again, it doesn't necessarily have to be paid users straight away, but what are the users who are using your product actually saying? Is this something that they would use every day? And at the end of the day, is this going to be something that they will be willing to pay for? Because ultimately, that is a really big factor in this. As an investor, you want to ensure that you do get a return on that investment. The way to get that return is to make sure that this product is a product that people are going to pay for. Yeah.
Well, I think
so,
go ahead,
Jessica.
Piggyback off of that, just, I think we spent a lot of time de-risking. We're first-time founders, which is, something else that investors look at. But really also surrounding yourself with the smartest people that you can find. We spent a lot of time bulking up a strategic and a scientific advisory board with the best people that we could find who also shared in the mission, of Othello. And that helps too, especially, if you are a first-time founder, there may be question around, how to execute things. And so surrounding yourself with people who can be honest and are supportive is another way to show value to investors. If you have scientists and people who are buying into this, then it gives you a little bit more validity.
Yeah, and I think, bouncing off that again, like if you ask people for money, you'll get advice. And if you ask people for advice, you'll often find money. So looking at that as well, and being sure that, you have the conversation, talk to them about what you're building, and find people that want to follow you within that. Like, I think the whole thing about being a founder is that, you're paving the way for something new. And the idea behind that is that you find people who want to follow that and build that groundswell.
I'm a big fan of surrounding myself with smarter people who can give me meaningful advice. So since we're doing this with StartOut here today, at StartOut, we celebrate obviously the economic empowerment of the LGBTQ plus entrepreneurial community. And it's an interesting question that people ask me sometimes a lot as well. It's like, how out should you be as you're out there looking for investors, and what are the the implications of that process of that being out there, so to speak? So I'm kind of throwing it to both of you, really.
Jess.
Yeah, I think Ben touched on this briefly, but authenticity is something that I know investors look for. It's also something I look for as a founder with somebody that I'm going to have a long-term relationship and I'm going to trust as being a part of my company. I am of the mindset of I am out with everything. I don't want to have the awkward conversation one day with an investor when they ask about my husband, but I say, oh, sorry, I have a wife. But also it's a great kind of filtering tool early on with investors. If an investor is not okay with, me being from the LGBT, plus community, then that's not somebody that I want on my cap table. And I think that it kind of weeds out people that probably are not going to be a good relationship or fit for the company long-term.
Yeah, no, I completely agree with that. Absolutely. Being your most authentic self is the only way really to ensure that, that you're not focusing on anything other than solving the problem that your company is focusing on solving. And so if you're able to do that and do that with confidence, then 110%, that's the sort of people I want to invest in. So, and as an investor, as we were talking before, like, you want to align yourself with people that you want to support. And so understanding, okay, well, diversity criteria and things like that is one thing, but actually focusing on the people that, at the end of the day, we are people. So understanding those people and those founders and that's who you invest in. Yeah.
So it's kind of a follow-up question. So how do you, as a funder, Ben, sorry, I'm going to throw it at you here. How do you look at co-founders who not necessarily fit in an LGBTQ plus box, but could be, but who are also married?
Yeah.
So how do you look at that as a funder?
Yeah. So finding co-founders is always an interesting thing, and I think the big thing as a founder is like making sure that co-founder complements you, right, in what you do, and actually is where you are not strong, obviously fills the strength for you. And so I think that's really important. From that element of, do they have to be part of the LGBTQ plus community? No, not at all. I don't see that to be a big thing. But however, what I do like to see is that those co-founders will support you and to be your most authentic self. And so making sure that co-founder has your back 110%. And so if no matter what that relationship is with your co-founder, it doesn't matter who that co-founder is, as long as you both have each other's back and ensure that you can both be your best self, then that's going to be the success of your company.
That's great.
Yeah. I mean, I have a co-founder who's not from the LGBTQ community, but she, again, like Ben mentioned, we have different strengths. I have a heavy clinical background and she has a heavy business development background. So it balances out. I need to have that business acumen as the same as we need to have, kind of the clinical experience. And I think that she's incredibly, supportive of who I am and, of my relationships and respectful of that. It's very much, even if you are not married to your co-founder, it is also a marriage in many ways. Like you talk to them constantly. Exactly. So make sure you like that person.
Yeah. I think the other side of that as well is that thinking about not only the strengths that you bring from a company perspective, but also like the perspectives that you are able to bring on the greater community as well. Having somebody who's marginalized, having somebody who is not so marginalized, understanding what that looks like too. So you're able to create a product that fits all people, I think is really important as well.
That's a great way of saying that. So I'm going to switch it up a little bit here. So how do you, and I think this may be for Jessica, but really for you both, how do you pitch to an angel investor, to an investor with absolutely no technical background? And you touched on it a little bit earlier, Jessica, but how do you, if you go to a technical product to an angel investor and that person is in the dark, so to speak, how do you approach that?
Yeah. I mean, it's interesting because we've done a lot of pitch competitions and things like that, since we started. And that actually helped a lot because, being able to concisely communicate what you're doing and to be able to explain it to anyone, to me is just kind of part of the job description. If you can't just explain what you're doing to somebody who doesn't have a technical background, then you should probably flesh out what you're conveying a little bit more. And in our case, we work with women with breast and gynecologic cancer. You should not have to have a medical degree to be able to understand something about your patient care. And I think that's just translatable across anything in business. So I think that, really not using a whole lot of acronyms, not getting too in the weeds with getting too overly technical, because that was something I did a lot early on, because, I just assumed people understood that. And so then, being able to tell anyone, if you met them in an elevator, if you met them, at a restaurant, to be able to tell them in 2 seconds or 30 seconds what you do, is really, really critical. And I think that be creative also, show visuals. If you have mock-ups, if you have, if you have interviews that you've done with potential clients or with customers or users, those are, quotes or things that you can use to help the angel investor understand, the value, even outside of just the typical showing market, data and things like that. But yeah, Ben, excited to hear what you think on this.
I'm not a technical investor. I will definitely say that now. I rely on my founders heavily to educate me on the problems they're solving and the industry that they're solving that problem for. Going back to what Jessica said, I like to think you should be able to explain your product or your idea or your problem you're solving to a 95-year-old and a 5-year-old. And if you're able to do that, then you're able to capture pretty much the entire market to understand it. And so being able to sort of talk about it in that sense, you should be able to share what you're solving to anyone and they should be able to actually understand that. And that I think is the most important thing. And again, like I said, as an investor, I rely so heavily on my founders to educate me on the problems that they are solving.
And as you're out there in the beginning, especially, and you are, you're raising your money or trying to raise money, how do founders demonstrate the progress they're making if they don't have contracts in place, if they have no customers yet? So what are you looking for, or what can you share? What are those different KPIs or pieces of progress that you're looking for at that particular stage?
I think it's, again, it goes back to that point that it's really, at the very early stages of investing, you often don't have a lot of data to go off. You don't have contracts. You haven't really built out a lot of that infrastructure. You haven't got a big team working on the project, etc. And so it's often a challenge to show that you are, that you have KPIs. But building towards something is really important. So understanding what is the MVP, what does that look like? How have I got to the point where I am today, and how far have I come? How have I got to that point as well? What problems have I solved? Who have I met? How many conversations have I had? How many customers or potential customers have I had touch points with? Showing that you're building out this brand and this name, and also have some contacts in the industry that you're hoping to solve for. That's really important.
Jessica, which ones were you using as you were going out in the beginning?
Yeah. I think a variety of those. So, I mean, we had an interesting journey, product pivot, rebrand, all of the fun things. But I mean, we did over 100 interviews with, potential customers, with, patients and users, caregivers, people from within, our market space. And that was really helpful, not only from the standpoint that it gave us a lot of validity and content to use around testimonials and quotes, but it also really helped us understand where the pain points were and what we needed to actually do, because you can have a great idea. And there have been things that I thought would be a great idea with our platform. And then we talked to people about it and I was like, cool, no one wants to use that. And you have to just be willing to accept that that's going to happen. You're going to have changes and you have to be willing to flow with that. But we also used, other things. We send out usually monthly updates, to everyone within our network, even if it's quarterly, that's fine. But, celebrate the successes with the people who are supporting you. Do you have a new advisor that you brought on? Are you in an accelerator? Are you doing a pitch competition, presenting at any conferences? Those are participating on a panel like today, those are things that, are helpful to show that you're making progress, that you are, an opinion lead within your industry. And kind of in the early stages, like that's a lot of what they have to make decisions based on, as long as you're progressing. And of course, when we, started getting mock-ups of our product and everything, it was so exciting because it was like, finally, we can see this, and those are the things that it doesn't necessarily have to be the kind of metrics that you're thinking of when you're getting towards like seed series A, but just showing that consistency and that you're continuing to fight through the tough times of being an entrepreneur, I think holds a lot of value.
Yeah, I like that you said that, just that you went out, even without having a product, you went out and got that customer research to understand that you're building the right thing. If you show that sort of data to an investor and show this is what we've done, and these are the responses we've got, so we ensure that we are going to have product market fit when we do have the product, that's a win, absolute win. Yeah.
So talking about those conversations, Jessica, and also other people around you, advisors around you, how do you make sure that the advice you're getting is honest advice, on your pitch, on what you're doing as a product? So how do you get that meaningful feedback that makes a difference?
Yeah, it's funny. I've been really fortunate. I was assigned, did the mentorship program through StartOut actually, and was assigned a mentor. And he was actually with a VC. And we had been pitching and, we kept hearing our favorite catchphrases, too early, not enough traction, proof of concept, all of those things and entrepreneurs love to hear. But what we weren't getting is any feedback on why, and some people also didn't seem to really get what we were trying to do. And in my mind, I'm like, this is crazy. It makes perfect sense to me, but it's not translating. And I sat down with my mentor the first time and he kind of started out and he's like, I'm going to apologize in advance. Please don't be offended. I'm just going to tell you what I think works and what may not work. And this is why. And that was a kind of life-altering conversation because he just explained from an investor's perspective why a certain piece of the product or where we were targeting our product wasn't going to be a large enough market for us to really show the kind of traction and revenue that we needed to scale a business. And we were like, oh, well, how come no one told us that before? So then it was kind of go back to the drawing board, talk to my co-founder. We're like, so are we just going to chop this piece off of what we're doing? And we decided to, and it really was a simplification of our product. And when we started talking to investors after that with this new pitch and a new take on the product, it clicked. It was instantly received. We had a pitch that we were doing that week, for a demo day. And within 24 hours before our pitch, we completely changed the pitch to go with this new idea. And the feedback and reception was instant. And so I think, like I mentioned before, you have to be willing to take that hard advice. They always say nobody wants to be told their baby's ugly. And that's very much true with founders and products. Nobody, and most of the time, no one will tell you your baby's ugly. They'll tell you, maybe your baby's too early, or maybe we'll love your baby one day, but we don't love your baby right now. And that's hard to hear. But if your goal is to make impact and to have a successful business, then you have to be ready to pivot at any time, really. And somebody told me that early on when we started, and I was like, we know what we're doing. This is going to be fine. But it's the willingness to listen and to take that, but also take it with a grain of salt, because everyone is going to have a lot of opinions on what you're doing. But like in that case, when we pitched it the first time, instantly made a huge difference. That's how you can test these things out too and bounce them off of your advisors and other people who are trusted.
Yeah, no, I agree with that completely. I think, remembering that your advisors are potential customers as well, right? And so realizing that, they do have really great insights, but not all of those insights are exactly what the market may be wanting or asking for as well. And so really, testing that out, testing, that advice on current customers or potential customers as well is really important as well.
So we've all been in pitches, all three of us, and how do you flush out, when you get some of the feedback? Wouldn't it be great? This is a great idea. That is a great idea. How do you really flush out what is, meaningful advice versus not so meaningful advice, and how do you change your approach to that? Any advice, feedback you can give on that from both of your perspectives?
Yeah, I mean, I think for me, some of it is just gut instinct to some extent. I mean, I hate to say it sounds kind of, stereotypical to say that or, whatever, but if somebody says something to me and I go, I hadn't really considered that to me is a time when I need to take that back and we need to look at this further, and see if there is some validity to that. And I mean, I'm a data-driven person. Science is my background, and we base everything we do with our company based on data. And if the data tells us that this is a right move, whether it's financially or for the quality of care of a cancer patient, then that's what we're going to do. Even if it's something that I would have never thought of, that's fine. So I think, my approach to this is go where the data tells you to go. And if the data supports what that person says, then it's probably pretty sound advice.
I think the other side of that as well is that, you don't have to make a decision today, right? You actually can take time to really think about it, process it, and really understand and come up with a path if that's where you decide to make that adapt or change and adapt to it. Make a plan of what that looks like as well. And so if you really do focus and plan and become strategic about making that shift, then it's much easier than just making a decision on a whim and changing everything. I think that it's really important to really take that time to really understand whether or not it's going to be a good move, not only for the company, but also for the customers that you're addressing as well.
So, and as you're getting good feedback and you want to work with mentors around you, how do you go by, Jessica, how do you go about finding, mentors and also working successfully with them?
Yeah. For us, we had some people who were in our network to begin with. We both worked in our industry for a while. But in some cases, it was, I would go to conferences. Everything was just kind of in the start of the pandemic. So everything was remote, which was kind of nice and helpful to early entrepreneurs. And, one of example was one of our current advisors. She's a professor at Stanford. And I saw a presentation that she did at a conference, and I sent her an email, and then I sent her a LinkedIn message, and eventually we ended up connecting. And I, it was basically just a conversation that, I love what your background is in equity, of healthcare, and it gets to the point where then they kind of look at you and go, so why am I here? Like, why are we having this conversation? And it's kind of like asking someone to prom. It's, get a little sweaty, you're afraid they may say no. And, and we asked her, and I was like, I have nothing to lose. She may have no interest in this. I was fortunate enough, we were fortunate enough that she was. And I think that it's really finding the people that have background that you don't have, that have more experience than you have within the industry, but also making sure they have the time. Everyone's at different stages of their career as well. So not everyone has the time to commit to an advisory role. And we've structured our agreements pretty, fairly loosely. We at times may have more of a demand or need to meet with one particular advisor. If we're in product development, say, we may need to work with, our architect people more, but being flexible and knowing that you can communicate via email if you have quick questions, but at least making sure that you maintain, quarterly consistent communication with these people, preferably once a month, and that can change based on where you are in your business development.
I think also, like, to piggyback off that, like, mentors want to see you be successful as well, right? Because at the end of the day, they're investing their time in you. They may not be able to invest their capital, but they are able to invest their time. And so when you think about that, remembering, time is valuable. And so if they're willing to put their time in, that's really important. As Jessica was saying, like, finding people who do have that time is important. And then also, like, the other thing is that, people who want to see, changes in the industry as well are often great mentors, because they can give really great advice from that internal perspective of the industry, but then also see what challenge you're trying to solve and actually help guide you through that from their own experience as well.
And Ben, what makes for a good mentee?
Well, obviously doing everything I say. No, I'm kidding. No, I think what makes a really good mentee is actually having a conversation. Remember, I said earlier about educate. Like, I hope that people will be able to educate from both sides. Mentorship works both ways, and so actually being able to educate and have a conversation and discuss. I might say one thing, but if Jess's experience within the industry shows something very different, having that conversation both ways and problem solve together is the way that you're able to come up with great solutions, I feel. And so, working with a mentor, it's not just a one-way relationship, it's a two-way thing and a two-way conversation. I think it's really important to remember that mentors don't have all the answers. Instead, they're there to help guide you and help you get to the point of being able to get to the right solution. Yeah.
And I want to make sure we have some time for questions here as well. So I'm going to wrap up here with my last question for you. Let's start with Jessica here. So what helpful resources have you found for entrepreneurs as they're getting ready to fundraise?
Yeah, I would recommend, there are a number of databases, Crunchbase is always there as well around investors. As a female founder, I've spent a lot of time. There are different resources that are out there. Bank of America, for example, has a listing for female founders of different investment firms out there based on stages. And for us, we maintain our own tracker. We have a tracker of these are the people we've engaged with. We take notes. This is the last time we spoke to them. Here are the rankings of our top tier investments that, investors we want to work with in future rounds. And also early on, be mindful too of thinking about the long term with the investors that you're working with in those resources. Do they only invest in seed, or do they have follow-on investing? So I think definitely educate yourself with the different webinars that are available out there that, Nasdaq has, that StartOut has, to really learn more about that process, because, I didn't know anything about financing or funding a company before I started one. And it's a learning curve. And so really engaging with, different groups that are there to support entrepreneurs like, we have here today is really been a lifeline for me over the last couple of years.
Fantastic. And Ben, what about you?
Yeah, I agree with what Jess just said there around finding a community, depending on where you are. If you're a founder, finding a founder community that you can actually lean in and get the resources that you need. And then also from an investor standpoint as well, finding investor resources, like finding a community of investors. There's so many programs. I did like Venture Capital University, which is part of Berkeley. And that was phenomenal, just to really give me a really good understanding of like the industry and some theoretical knowledge, as well as a great network of people that I can get great practical experience from as well. And then, again, like just thinking about, On Deck Angels is another one. There are so many different opportunities where to build community. And also I'm a big believer as well is like talking to other investors. The more you talk to them, the more that you can learn from each other and understand, okay, well, how do you make decisions based on companies and what's the right decision for you? How did you get to that process and what made that company attractive for you to invest? And so understanding how people make decisions as an investor allows you to also sharpen your tools as an investor as well. And to see if there are any red flags pretty early on too.
Thank you. Perfect timing. So Jessica, Ben, Thank you for sharing your expertise with us today. I really appreciate it. It's been fun. Wish you had another hour, but I want to turn it back over to Colin to see if there's any questions from the audience. It was good seeing you. Thanks for being here today.
Awesome. Well, thank you, Al, for leading such a great discussion. Ben, Jessica, thank you for sharing your insights. Really appreciate it. The topic, raising more money. What do you know? And you guys are sharing about all of that. So we've got some great questions. If you haven't dropped any questions into the Q&A box at the bottom of your screen, please do so. We'll hope to get to them all. Ben, first question up for you. If a primary differentiator of your pre-seed company is you, the founder, how do you prove that is a viable defensibility?
Sorry, can you ask that one more time?
Yep. If the primary differentiator of your pre-seed company is you, how do you prove that as a viable defensibility?
I mean, yeah, I mean, well, that if you're the only differentiator, then that you are the differentiator, right? So you can prove that pretty fast, I would say. But within that as well, like looking at your competitors and understanding what those differences are is really important, and actually being able to explain how you as either a person or a product within the ecosystem is different is really important. You know, obviously Me Too products are one thing, but actually understanding how you go about tackling that problem differently is really important. Yeah.
Yep. Founder market fit.
Exactly.
As I've heard. Next question, and Al, feel free to share some of your expertise here because I know you got a lot. How do you attract top talent early?
Yeah, I mean, I'll give a stab at it. But yeah, I mean, I think that passion that you have as an entrepreneur and as a founder is how you will attract the best talent and top talent in the industry, because you know, I can get on my soapbox when it comes to talking about my area of the market that we're working in. And that translates, you know, people see that you're passionate about what you're doing and they want to be a part of that. But, you know, it is a competitive industry and market right now in general for attracting people. So I also think that it's, you know, about the fit with your values as an organization, and how you're going to build a team that's really going to sell people. I mean, if somebody wants to go work for a giant tech company out there, they're going to likely go work for a giant tech company out there. But if there's somebody who wants to be a part of changing the paradigm on something, they want to be part of something innovative and wear a lot of hats, those are the people that are going to be ideal for working with a startup.
Yeah, I agree. Like, you know, there's no way a startup can ever compete against a large organization from a financing perspective, right? And so, you know, if you're unable to offer the remuneration from a salary standpoint, what is it that you're able to offer? And so if it's career development, if it's, you know, juggling many hats, if it's doing all of those sort of things, then those are the things you can start offering. And ultimately, like Jessica said, having that mission aligned is the most important thing.
I so agree with that whole mission and your authenticity. If that aligns, it is not that challenging to attract great people. So important. We've experienced that too here.
Yeah. Super helpful across the board. Let's see. Well, you're all advisors to startups in one way, shape, or form. Somebody's asking if you want someone to be advisor, but you can't afford them. How do you thread that needle?
Yeah, I can take that one. So, I mean, we started out with no money. But it might as well have been negative money because we were putting all of our money into what we're doing. Equity. You know, so we have, you know, at early stages, I think that everyone is a little fearful that somebody is going to want a paid advisor position. But if you're a young startup, most people go into it with realistic expectations that you don't have a lot of money to pay them. And in many cases, they wouldn't want that anyway, because the goal is for you to build this product and get it out there. So it's really simple. You know, you have many templates out there, but, you know, preferably a lawyer goes through this, but, you know, you set up an agreement, you know, 4-year vesting schedule. For some, you know, some are a little bit different. We have some that are 2. You know, you may want to have a cliff in there to say, you know, maybe after X amount of time, if this advisor relationship doesn't seem to be working out or needs change, you know, that it may be best for either the advisor or for the organization to, you know, end that arrangement. And that's okay. You know, companies change as they grow, but use equity. Be sparing with it. Be, jealous with your equity is what we were told. Reserve what you can, because every round of funding it depletes. But on the other hand, if it's a great advisor you really want, that is not an area that I would skimp on equity when it comes to my company, because these are the people that are really going to get you off the ground.
I also think that, at the end of the day, most advisors don't go into it thinking about what they can get out of it either. And so I would be aligning yourself with the right investors advisors who want to give you advice and actually help you. And then, your job as a founder is to actually reward them for that advice. But it doesn't have to be being rewarded on day one, absolutely. And I highly recommend putting people, if you do put doing an equity payment sort of plan, but making sure that there is that vesting schedule as well.
Super helpful. And along that same similar vein, we just got another question. How do you think about fair benchmarks for advisor equity?
Yeah, I've heard a lot of different, things on this. There are some interesting resources out there. I think Y Combinator has some information on this, but it really shows, it's kind of a grid, and it shows this is where you are in your company. Are you at the strategic phase of your company? Because the younger you are, kind of the more equity they may actually be expecting. And as you go up and you're becoming more advanced, you may not have as much need for that type of intensive advisory. But I think that it can go anywhere from like 0.25 to 2%, is kind of the range that we've seen. And it really also depends on what value and in their name and their background does it also lend to your organization. Because, I am, in my late 30s as a female, and I don't have 40 years of medical oncology background. So, those are people that are going to be valuable, and, you don't have to give away the whole company, but, address it accordingly based on their experience and what they're adding.
Yeah, absolutely. I think the other side of that as well is ask other founders what their contracts will look like with their advisors, just to make sure that you aren't getting ripped off as well. I think one of the challenges as being a first-time founder is that often people can take advantage of you. And so making sure that you do protect yourself is really important. So getting advice and understanding what other people are doing will really help you make those decisions as well.
That's great advice. Speaking of advice, what's your best advice about hitting the sweet spot between raising too early to show the best traction and raising too late and missing the opportunity to dominate the market? I'll open this up to all of y'all.
Loaded question. We've been cautious with our fundraising. We did not want to dilute the company too early. So we kind of have brought on as little capital as we know we needed realistically to continue moving the product and our company forward. With the knowing that we'll be able to raise a larger round later as a result, because the valuation and the traction of the company will be further along. But I think be realistic with yourself too. You don't want to under fundraise because then you don't want to be sitting here and you go, wow, my runway is like 2 weeks and I need money now, because raising money always takes longer than you think it's going to. And just be aware that there are also bridge rounds, are becoming more popular now, to where, especially in early investment community, where with founders, that if, you need to get to your next inflection point. And if you can show that you're on your way to an investor, then they're likely to invest in you if it means it's going to get you to that next stage to continue advancing the company.
I think, on that, raise when you need to raise. If you're looking to scale, raise, because that will help you raise. But at the end of the day, like Jessica said, giving yourself that runway, 12 to 18 months is really important, because fundraising is a full-time job as a founder. You can't really spend time working on your business, because you are absolutely every day hounding the pavement, trying to get more fundraising or getting that fundraising in. So I think it's really important to understand that and understand how much you need for that 12 to 18 month period in order to grow and hit the KPIs that you want to hit, in order to then raise an additional round after that. Yeah.
Super helpful. Al, anything to add there?
No, I think both Ben and Jessica covered it. So it is important to have enough in the bank, so to speak. But I'm also, as a in the company have always struggled with the, when to raise, at what valuation, because I'm a little bit, I like to keep as much of the equity to myself, so to speak, to the co-founders, and give it away.
So
It's a really sort of fine line, and it's raising at the right amount, at the right time, at the right amount, and so it's a little bit of it can be a little bit of a puzzle.
I think one thing to add there as well is that, focus on revenue generation yourself anyway, which makes that your company is sustainable. And so you don't need to raise in. So when you do need to raise to scale, it's a very different conversation. You're not desperate. And when you're not desperate, then you take good deals versus when you're desperate, you take bad deals just to get money in to continue the company. So being really conscious of that is really important. And so if you're focused on actually creating revenue for you and actually becoming a sustainable business rather than just a startup, then it's a very different conversation. And that from an investor standpoint makes you so much more investable as well.
Mm-hmm.
Yeah.
Also look at it.
Bringing up the keyword of revenue and controlling your own destiny. Ben, you brought up a little bit on valuation. If you're pre-revenue, how do you approach valuation? Any resources you all would recommend?
I mean, as Jessica said, Y Combinator has their docs, which is a really great place to start. It has a lot of information in there around where you should sit from a valuation. Depending again where you're raising and what stage you're raising at. I invest pre-seed, so what I look for is valuations typically 3 to 8 million, somewhere in there is pretty good. Like 5-ish is pretty much standard. I find. But again, it also depends on the industry. It depends on what your product you're building. It depends on so many different variables. So looking at like companies as well and seeing where they are too. I know that there are definitely market contingencies on that. But I also feel like don't be greedy upfront. Don't remember that too. Like you're a very long way from actually converting that equity anyway. So like we said at the very beginning, like don't focus on that. Focus on actually creating a company and actually getting product market fit and actually developing that side of things and then getting to that point of having revenue rather than focusing on your valuation on day one.
Yeah, I was going to say too, another piece of advice we were given, because we're preparing for another round of funding later this year, and of course, valuation and caps and all of that come up. But what some of the advice we were also given is, some of the founders we know of lately have started to see this overinflation of valuations at early stages of funding. And that seems great. In fact, in some cases, these investors are saying, I think you're actually valued higher than what you're trying to do with this raise. But keep in mind that could impact your fundraising down the road. I mean, if you're at pre-seed, seed, and you've raised on a really high valuation, there's only so much that you can really scale in a 12-month period before you're coming up for Series A. And that's going to be a really intensive, due diligence for that round of funding. And if you raised on too high of a valuation, then that could negatively impact, you for future rounds of funding. So that's another thing to keep in mind when you're coming up with that valuation.
Yeah, I completely agree with that. And remembering, we're talking about angel investing here. It is on a safe note. So it's actually not, the valuation really isn't determined by you. It's actually determined later on by the company that is going, by the investor that's going to, set that, conversion up.
That's great advice. Nobody likes a down round. We have some more questions, but we are at time. I really appreciate you both sharing your firsthand expertise in this arena and helping our entrepreneurs understand how to raise more capital to fuel that engine for their companies. So Al, Ben, Jessica, thank you so much for joining us today. We really appreciate it. And just can't be as grateful as much as I am today. Thank you all for joining us.
Thanks so much.
It's been wonderful. Appreciate it, everyone.
And for all of you still on, appreciate you all joining us, and we hope to see you all online soon. Thanks again, everyone. Have a great day.